They're always dropping tons of amazing tips on it. And I personally use it for myself so I can learn to be a better trader in the market. So afterwards, if you want to check that out, you can. But anyway, so today's topic, I just have a blank chart. And so I'm just going to be going over a lot of different setups for everyone. And the specific, I'm going to teach a strategy on Fibonacci. Okay. And the title of this is how to get the most accurate Fibonacci entry points. And we're going to be looking at Fibs, a lot of different examples and how I specifically trade them. So I'm going to go slow, and then I'm going to go over a lot of setups so that we are very clear on this at the end. And if anybody has any questions along the way, I got the chat up, so feel free to ask any questions that you may have. All right. So the first thing that I want to share with you is how to get started with Fibonacci. I'm not going to go into the history of Fibonacci. It's a mathematical thing, and you don't need to understand it, because guess what? I was really bad at math, and I still am not great at it. Now, I do like to understand what I'm doing, right? I do like to understand what happens behind the charts, what causes candles to move, but I don't get too worked up over how the Fibonacci sequences are. It's so simple. It's really just a percentage move of the retracement when you're talking about Fibonacci retracements, which is what we're going to be talking about today. So it's really simple, and I'm going to explain all of that as we go. But it is important to understand as much as you can about the market. You want to understand your strategy, but it's important to understand other areas like trading psychology and what moves the market and why the market's doing what it's doing. Those things are important because it just helps to reinforce your skills and building your skills and your knowledge as time goes on. So what we're going to start out with is a daily chart on the S&P 500. Now, another note is recently for Timing Research, I did a short video on how to do recession trading. And so if you're subscribed to the Timing Research list like I am, I'm sure you had an email for that, but you can go to the Timing Research YouTube channel and check that out as well. Talking about how to trade in recessions. And this Fibonacci, the reason I mention it is because in this Fibonacci strategy really works well with that. And one of the tips that I told you, or that I told everyone for the trading in recessions, is to be thinking more big picture and long term, and trying to anticipate when the market's going to reverse using weekly charts. Today, I'm going to be talking primarily with daily, but you can also apply all of these strategies on weekly charts. So that might be something that you would be really interested in. By the way, David just posted the link to that trading strategy ebook. So thank you, David. So if you guys were interested in for that later. But yeah, you can run all of the training on the Fibs on the weekly charts as you can the daily. And a lot of times I will check weeklies as well to get my bias down and to make sure that I'm seeing things clearly. I like to look at different time frames and different charts. So if anyone's paying attention in the chat, I'm curious, how many of you are experienced traders with Fibonacci? If you understand how it works, and just let me know in the chat, just type in yes. Or if you're a beginner, just type that in. I'm just kind of curious how many beginners we have. We got no. Okay, we got some yeses. Michael, not much. Beginner. Okay, beginner, false starts. Good. All right, we got a lot of different mix here. So if you understand Fibs, I think you're going to really appreciate this, because I'm going to show you some ways to help you avoid some bad trades, and also ways to help you to fine tune your strategy. Okay, so I'm going to give a couple variations on this as well. So you're going to want to stay tuned to that. And I don't have an official slideshow. So I do that on purpose because I want you to take notes, right? So take some notes, and it helps me work with the chart. So someone did say there's too many time frames to see what you want. Well, you know, I do like to see bigger picture, right? I like to see the big picture. It helps me zoom in for the lower time frame trades. So for me, I always want to keep the big picture in mind. All right, so the very first thing we want to explain about Fibs is that the Fibs will be drawn differently based off of whatever chart you're going to do. So I'm using a trend spider charts. And so if you, the indicators right over here, trading view charts are a little bit differently, you know, whatever platform you have it, but most of the platforms will have Fibs. So if you're measuring the current up move, which right now you can see this move right here is an up move, and you can see we broke out of this trend line right here. So we had a daily trend line and it broke. And so now we have this move, right? So this particular move right here. Okay, so that's the current move I'm looking at. And so we want to go to the previous move. Now, in order to draw the Fibs, you have to identify 2 points on your chart. You have to identify the top of the move, and then you have to, or no, did I say top? I don't know what's going on with me. You have to identify the bottom. This is the bottom. If I make mistakes like that, let me know. You have to identify the bottom of the move, right? Which is right here. Okay, and then you have to identify the top of the current move, right? So would everyone agree with me that this is properly identify that this is the bottom and that this is the top of the current move, that this is a what you call a swing low and a swing high? Would you all agree with that? And do you, not only do you agree with it, do you see how I did it? Yeah, from the previous move. Okay. Actually, so some great questions. So yes, the previous move. And so how do you determine your anchor point? Because it moves all the time. Actually, it doesn't move ever. It never moves. Once this is here, this candle is printed for all eternity. This candle is the low, and this candle will never move. Because why? Because it's a daily chart, right? That will never, ever, ever move. Okay. So what may move is you might get a new low. If it comes down here and makes a new low, well, yeah, that's now a new low. But this, at this point in time, this is the low, and this low candle will never move. It will be here forever. And now it is what is known as a support level, right? So this is a support level. Okay. Just like right here, this top candlestick pattern that developed, this will never move. And this is a resistance level. Okay, so you want to keep in mind whenever you're trading Fibonacci about your support and your resistance levels. Very important. Okay, so you have your support, your resistance, your swing high, and your swing low. Okay, so yes, this is currently in a down move, right? It's currently a down move. Overall, when you look at this chart, this is year to date. Year to date, the market opened somewhere around here, around 450 area. And year to date, we're sitting right at 400. So we're down about 50 points on the S&P 500 on the year. So that means that we've been moving down. All right. So that's in play. So now that's the first step of understanding how Fibonacci's work, is you have to identify your swing high and your swing low. So we've done that. Okay, so now you want to draw the fib on the chart. So you go over here and you click it, and we're just going to find that low point, and you're going to click it on the chart, and then you're going to drag it up to the high. Okay, so we found the low, and now we're going to drag it to good. Yeah, you got it. So now we're going to drag it. Okay, so now it draws the lines, and what we really got to understand is how this whole thing works. So it starts out, and you'll notice that these numbers here, this is a 0. Okay, and they're right, that's a 0. The top is 0. So where it starts is 1. So that's a 0 and that's a 1. Very simple. So I remember I said, you know, the math. You do have to understand a little bit of the math. And that is that it's 0 and here's the 1, and then you find the percent of the retracement. And so if we do simple math and we know, let's just say that we have a 0, and what's halfway between 0 and 1? Halfway between 0 and 1 is 0.5. It's 0.5, right? So that would be, actually, we're kind of sitting right near it right now, 0.5 right in here. I'm just estimating, but we're kind of sitting right in the middle, 0.5. That's halfway in between, okay? Halfway. Now, the reason these levels are drawn here the way that they are is because these are Fibonacci levels. And so that means that traders are looking at these levels quite regularly and quite often. So many times when you have a swing high and a swing low, it is going to go to these levels, right? It's going to go to these levels. And here's the levels that we have. And you can adjust these. It's adjustable. But we have 0.236, and then it has the actual price, 415.35, 0.38. So that's basically 38%, 0.61, 0.786, and then we have 1. Okay, and then it goes further as 1.2, 1.38, 1.61, right? And so these levels are all drawn on their chart. And basically, the reason we have these levels is to see at places where price can potentially turn around, all right? So we draw our fib. You can't draw the fib until the move is over, right? So let's continue, because maybe that's what the when someone was saying, well, the anchor points move. Well, that is true if you're drawing it right here. So you can see, and I'm going to zoom up so we can get this real clear. Right here, if I'm back in time and I'm analyzing my chart, and I'm like, oh, okay, I think this is the top, and I draw my fib. Well, it just kept going up. So a fib retracement to here isn't going to really help because the move wasn't over yet. You can see what happened. It had a bunch of candlestick patterns and they consolidated, but it didn't actually retrace. It retraced a little bit, like 10%, and then it made another move back up. So if you're watching this and you draw a fib, you really can't understand where it's going to go until it rolls over and starts to move down, right? So here it started to, but it didn't quite get there. So once you have it in place and you can clearly see that it's reversing. And the way that I like to look at reversals is by looking at the candlestick patterns. When you see a pin bar and then a big drop like this, that's a really good way to see that the move is starting to go down. Now, once you have that, you're like, okay, the top is in. Now I'm going to be patiently waiting. And so you'll notice that it went right back down here and it went to the 23. And it tried to bounce on the 23. It actually did bounce, but it didn't follow through, right? It was a nice little bounce, but it didn't follow through. So then we went right down to the 38 right here, and there was no bounce at all. It went, retested it, and it went right back down to the 61.8. So you'll notice how once this fake out happened, you see that was a clear fake. The price just shot right up and then went down. You can see how it just crushed through this level and then this level, right? So when you're looking at levels, the way that I like to trade them is I am looking for a bounce before I trade it, okay? And so right here, you'll notice that we had a bounce and then it went. And now, right now, we got another bounce. Okay, so there are some traders, and I'm just bringing this up because my way is not the only way, but some traders will put a buy order on this level and they'll try to catch the bounce. And, you know, as you can see, if they would have done it on this one, it would have worked. Had they done it on this one, it probably would have worked. If they would have done it on the 38.2, it would have been a loss. So if you're not a successful trader or you're not familiar with trading, one thing you need to understand about trading is that you're going to lose trades, even if you have a great and accurate strategy. So in this case, this is 2 winners and 3 out of 3 trades, right? 2 out of 3. So that's a good winning percentage. And the other thing you want to work on is the other thing you want to understand is the size of your win. Okay, so had you put your entry right here, it went at 388, it bounced up to 400. Pretty good. You know, that's a pretty good bounce. That's a nice size bounce, right? That's $18. I always tell myself to never do math publicly because I usually embarrass myself. But in this case, I think I'm pretty on point. No, actually, I'm not on point. I messed up. No, it's not. It's 18. See, this is why I never do it. It's $12. It's $12, not 18. But still, pretty good bounce. Okay, $12. And if you're buying options on this, and we're not going to get into that, but you could have made a pretty nice trade. Now, one thing, so Bruce asked a great question. And so Bruce is saying, how well does this work in congestive markets? Well, it doesn't work that good. So you want to use markets that aren't, and that's easy to find. Like, let's look at this market right here. This is the S&P 500. If we look at S&P 500, this thing almost never is congested, right? This is back here. Look, it's moving. I mean, the S&P 500 is always doing this, right? It's always doing this. So it works great on the S&P 500. If the market's always going sideways like that, then there's not really any reason to use a Fibonacci because you're going to be just range trading. You just buy the tops and the bottoms. That's all you do. You wouldn't need a Fibonacci. But in this case, the market moves. So this is a great lead into, yeah, S&P 500 is a great market, but this is a great lead-in question. So Bruce, the market moves in a trend like this. Okay. So whenever we have these moves, let's take a look at a Fibonacci extension. We could draw a Fibonacci extension on here, right? Right on these moves. And you can see, oh, on a fake move, it went to the 61.8. Okay, so you could just draw these all day. Here's another one. Let's delete. Let's get this one in play. Okay, right? This one went to the 38.2. All right, well, let's do one more. So in a trending market, this is just an amazing way to trade in a trending market. Right? It's an amazing way to trade. So let's see if I can delete all those now. Okay, so in a trending market, that's fantastic. I usually don't overlap my fibs because I want to see the current move. So if we go back right now, we have a really good opportunity. So now I want to talk, if you understand how moves work, right? They hit a higher high and a higher low. And the ideal situation in a scenario like this is to try to catch the move that goes from here to here. And that's because this is the biggest part of the move. The retracement, you could try to short, but the short's not as big. right? So the retracement, this part is the biggest part of the move, from swing low to swing high in a trend. And so once we understand that we're in a trend, we want to do that. Now, right now, the S&P 500 it's questionable. And so that's part of what we want to look at too, is identifying the overall trend. So right now, year to date, January 4th, we're at 477. We're down to 399. Are we in an uptrend or in a downtrend right now? So the last swing high was a big swing move, but overall, we're still down. So we have to kind of gauge and figure out if we're in an uptrend or not. So what I am noticing so you want to just do a little bit of basic analysis too on your chart and say, okay, we are in a trending market, but is it trending down, right? Is it trending down or up? So right now we're kind of in a mystery here. We broke this up, but we still haven't broke this uptrend. And so if we were going to trade this, are we going to make a new swing high? Is this going? First of all, we never know what's going to happen, but we just want to ask ourselves questions and think about things, right? We could be in a channel. I could draw that like that. Oh no, what's going to happen? If we're in a channel, where are we headed? Right here. So we don't know. We don't know what's going to happen, and we never will in the future, but we want to look at possibilities. That's what chart people do, is we look at possibilities. Okay, so I have drawn a nice channel here. There's a really nice channel on the S&P 500, and we're right in the middle of the channel. And so you want to say, okay, am I in an uptrend, downtrend, or what am I in? So we're in a downward channel. So now, since we know that, are we going to still take this fib trade, right? So we know that we're in a downward channel. Are we still going to take this fib trade? Well, we're going to draw this, and we're going to watch it. I like to wait. I like to wait to see the bounce. So one way that I do it is I draw an indicator on my chart. And the indicator that I like to draw is the 10 EMA. So let's go ahead and add that onto the chart right now, the 10 EMA. Okay. And so the 10 EMA a lot of times is the 10 EMA is my bounce point. So if we get a bounce off the fib and I don't break the 10 EMA, I'm not going to trade. Okay, so today, let's look at the last time. All right, this last time it moved down, it bounced off this fib, but you'll notice it went right to the 10 EMA and it went lower. Now this time is a little bit different. This time we went up and now we're trying to break. And so it's 223 and we are above the 10 EMA. So that means, according to my strategy, I am going to buy this today. I'm going to buy this today at the end of the day. I like to take a trade at the end of the day. So the market closes at 4 p.m. Eastern time. I like to make my trade in between 3:30 and 4 o'clock. That way, if I'm swing trading, I can only look at the charts for a few minutes a day. I can then place my trade and I can be done. And then a lot of times, if the market opens up the next day, I'll be up and I'm doing really well already in just a few minutes of trading. So I really like to do that. So it's going to close today above this 10 EMA. So I'm going to buy this. And where would I put my stop loss? I'm going to put my stop loss right here. Okay, I'm going to put my stop loss right here, which if I get my, I can draw my cursor right here. It's 386. I put my stop loss about 386. And so where would I target? I know that I'm in a downward channel, so I will be looking for the top of this channel to be hit. So I'm going to be looking for about 420, right? So you always want to look at your risk to reward. Risk to reward is very important in trading. So if I have today, I get in at 400, and my target is 420. My stop loss is 386. That means that I have a $20 target with a $16 stop, right? So that is a very good price. It wouldn't be it wouldn't be a $3 stop, because I'd be entering around $400. I'm going to be entering today. So 90 is a $10 stop, and then 86 is about a $14. So we're going at about a $14 stop with a $20 target. So that makes my risk to reward ratio better than a 1-to-1. That means that when I win, I will make $20, and if I lose, I make 14. And so if you do that, if you win 20 and you lose 14, and you win a 50% win rate, you will over time create a lot of profit. And I have a special calculator that I like to use. I'll show you here real quick. I have a special calculator that I use just so I know what my risk to reward ratio is. And so I go here to risk to reward. And so I'll say my average win. If my average win is $20 and my average loss is 14, okay, so there it is, that my profit factor would be 1.43. And then I can just put that in my calculator, 1.43. And if I take, if on each trade that I lose, I risk $100, and I take 1,000 trades over the course of a year, you can see at 1.43 at a 50% win rate, I'll highlight it here. You can see my profit level would be $21,000, and that's only risking a mere $100. That's a mere $100. Now, 1,000 trades is a lot, but even if you took 100 trades, you're looking at $2,150 in profit, right? So that way, you can understand what your strategy can do, and it's important to monitor that. It's important to monitor that. So even though this trade is probably not the absolute highest probability trade, I would still consider this, because I know that I have a good risk to reward ratio, and it's got a pretty good chance of winning. But would I take this trade? Well, the answer is, if I can find something that's better, then I will take the better trade. So think about this, okay? If you got two trades and one's a higher probability, should you take both of them? I'll pass on one and take the other. And so what would be a really good trade that you would want to look at? What would be a very good trade? I can share the spreadsheet. I will, if for anyone that wants the spreadsheet, just if you send us an email at, I'll give you my personal email at caseystubbs@gmail.com. I'll send you out that spreadsheet at the end. Just everybody send me an email, and I'll gladly send you access to it. All right. So what we need to do now is, okay, is that a trade that I would want to take? Well, I would look for something that would be an even higher probability. This is a good trade, and I would probably take this trade. But what's the highest probability trade? Well, the highest probability is something that's trending a little bit better, because this is in a downward channel. We would probably be better off if we found something that was in a movement like that. And so, if we do that, we know that we're going to increase our probability because this is a very high probability trade. And not only does it increase our probability, but it helps us find bigger winners. So one of the stocks that I have been looking at recently and been trading would be this one, Elf Beauty. And look, it's interesting. The chart moved in perfect alignment with how I drew the trend. Tell me that's not a crazy coincidence. Like, did you guys just see that? I did not have, I promise you, I did not have that planned out. But it did. It worked. The chart is moving in perfect alignment. Okay. And so I like to find something that is a little more trendy, right? So if we look at this, and let's take a look at some of these past moves. I told you I was going to give you some examples. So we go, let's run this move. Okay. Right. So this move came down and it went down, it went into the 38.2 and it bounced. And then look at that. It moved really nicely, a big move up. Okay. So now if we want to move this to this one, let's run the next one. Okay, this one pulled back. It didn't quite go. And a strong trend, it might not go all the way to the 68 or even the 32. This one went to the 23, consolidated, and it moved back. And we had a very nice move, right? And so let's do the next leg. So here we pulled lower. And where did it go? This one did pretty good. It pulled back right here. This one pulled into the 38.2 from here to here. And then it crossed above the moving averages. And then we had another nice move. So now I've been watching this one the other day. And sometimes this can be a little challenging on drawing these fibs. You know, you can because really there's a big swing high. If we go, let's get rid of this. You can see there's a really big swing if we start down here, but then there's all these tinier moves, right? So when you're in an uptrend, you don't have to go all the way to the bottom. You can go to the most recent swing, right? You can go to the most recent swing. So in this case, this was the most recent swing low. And so we would go, let's zoom back up so I can see this a little bit better. Practice, practice, practice. You're absolutely right. So here's the swing low right here. Here's the swing high. All right. And so now I would be waiting for this to come back down into the 61 or, you know, below the moving averages, 70. And then when it does, I'll get back in, right? So this is a nice consolidation up here on the top. If we get a pullback, then it could be one that I would like to trade. So I like to trade something that has been trending more recently, but just know that there is no such thing as a total home run trade. You just don't know. The other thing that you got to remember is if it's been trending for a while like this, it will be due for a deeper pullback. And in that case, if you get a deeper pullback, and I know I'm throwing a lot at you, but this is just stuff that you learn over time. If you go the big move, you might get a pullback all the way to 32. And if that happens, then you'll wait for consolidation, wait for the bounce, wait for it to cross back up above the moving averages, and then get into the trade again. So this is one that I really like right now, but I have not traded it because I'm just hanging in there waiting, right? Just hanging in there waiting for a retracement. Okay. Another one that I'm looking at as far as a really strong one that has moved pretty good is ENP ENPH. Okay, and so if we look at this one, we had a big breakout yesterday, a big, huge move. But over time, you know, since the beginning of the year, we've been moving up really nicely. You can see the uptrend. And right here, we have a swing low and a swing high. So let's take a look at our fibs on these. Here's the swing low, and here's the swing high. And this one went to the 23, and now we had the move. Well, what you want to notice here is this did break above, so I would have entered this trade right here, and I would have put my stop loss below here. And so who knows? I didn't take the trade, so I don't know. I might have got stopped out, or I might not have, right? I don't know. I'm zooming up to kind of see. Because here, and sometimes you get stopped out, but right here, 272.96, I would have put my stop below that. I might have put it at 270, so I might have made it. I don't know. But the point is, if I would have got stopped out, my risk on this would have been 293, stop out at 272. That was about $20. But I would have taken the trade again. So I would have, let's just say for the sake of practice, that I lost this trade. We'll put a big L. Okay, and the stop loss was about $20, so it was a $20 per share loser. Now, in this case, I would have re-entered though here with the stop loss here. So again, in this case, my entry would have been right here at 294, and then today I would be sitting up at $318. So I would be my entry would be over the 20 that I lost. So I would already be up even if I had lost that position, right? So I don't mind taking the trade twice if it sets up twice, but it's important for me if I put my stop loss to take that loss. Why? Why is that important? Well, let's take a look at the chart and we'll show you why. Because you might get in on a pullback, right? You know, so I just want you to understand that these don't always work. And so we get in here on previously this move, and I would have got in, and maybe I entered the trade right here. Look at this. This is a suck in. It means it sucks everybody in. Here was my entry. See how it closed above? 257 is my entry. And I put my stop at $17. However, if I didn't honor that stop, I'm just down $112. I'm down all the way down to 112. Like, you see that thing, right? You don't want to hold it that long. I'd rather take the $17 loss than to hold it that long. Now, yes, it eventually came back, but look how long it took. I mean, this was January 22, and you know, it took a year. It took a year to come back. You're not going to become making money if you have to wait a year, and sometimes it never comes back, right? So you just don't want to do that. You want to make sure that you honor your stop loss at all times. Okay, so very important that you honor your stops, and you got to understand that you're not going to win every trade. So if it triggers again, well, then sure, you know what, take the trade again. In this case, I would have been able to make that trade. Now, another point that this is really important, and I want you guys to add this to your notes. Okay, another really important point here is that if you get a fib retracement and you get a chart pattern, that is something that we really want to look at. Okay, and so when I say a chart pattern, I want to show you there's a chart pattern here, and that is a double bottom. You see how price came here and then there? That's a double bottom. It's a very famous chart pattern. I mean, traders are looking at that all the time. So whenever you can get confirmation of a chart pattern on top of a Fibonacci retracement plus the moving average break, again, that's just more confirmation on a trade. And so here's how I do this. If I am trading and I see that it crosses above, it bounces off the fib, that's one thing in my favor. If it bounces off the fib and then it crosses above the moving average, that's all I need. That's 2 points for an entry. But then I see that there was a double bottom here. I'm like, oh, now there's a double bottom. I'm going to go for it. Okay. Because why? Because that brought more confirmation. Now, if there were two trades, this is just how I do it. If I have to decide, I can't take every trade, and neither can you. But if I have to make a decision, and we have to make decisions, I have something that will help me make that decision, and it's called more confirmation. So if I'm looking at trading ENPH or trading ELF, and ENPH has a double bottom and ELF doesn't, that is an extra confirmation. I'm going to trade ENPH, right? So if you combine these fibs with other chart patterns, candlestick patterns, bullish engulfing patterns, those additional tools will help you. All right, so now another thing that we can look at for additional confirmation is there a support level? And it's just amazing. Wow, look. That same place we were talking about making the trade earlier, it just happened to stop at that same price, 276. Imagine that. So now when I'm taking this trade, I've got a fib bounce. Let's draw the fib just so we can see it. We've got the fib bounce off of the 236. We've got what else? A double bottom. So we've got fib, double bottom. What else? Oh, we've got support. Okay, this is like you're building a case, right? It's like when you're mad at your wife and you want to really slam her with evidence. You're building a case. And actually, I don't recommend that you do that. It's going to cause trouble. I would never do such a thing. Well, I did it once and I learned my lesson. But anyhow, so now I've got fibs, double bottom, support, and an MA cross, right? Okay, and something else that I have, if I look up, we got the double bottom, but there's something else too, right? What else? Well, we have a price action. I love price action. Study your price action. We have price coming down, making a new low, and then this price breaks out the top. We have a bullish engulfing candle. And what I mean by that is this price engulfed that. It took the high of that previous candle out. That's a bullish engulfing candle. And so that, again, is another confirmation. So we had a lot of confirmation on this trade. And that helps you when you're making decisions. The more things that you have in your favor, the better. And you know, there's one more thing we could add to this, and that is a strong trend. Okay, we have a strong trend. So even that even makes it even better. And strong trend is for me the #1 qualifier. And I mentioned that earlier. I said I like to try to find something that's trending. So that's the #1 qualifier. And what we can do too is let's look at it on a weekly time frame. Okay, for me on a weekly, look at this chart on a weekly. I love this. This is beautiful. This is a bullish engulfing on a weekly. It just cleared this entire box, right? It just cleared that entire box. So one of the things I like to see is that it's above the 10 EMA on the weekly. And I like to see if there's a price action pattern on there. Matt, you're doing a great job. You got some good notes. Good job. And you can do these fibs on weeklies too. You know, you can, weekly's probably my favorite time frame. Just saying. But you can draw a fib on a weekly. So let's see. The question that we had was, there's a question. What if you go, oh, I got to go back to a daily. for that. What if you go back one low? Will it be the same fib levels? Let's take a look. Let's see what he's talking. See if I can figure this out. All right. Clear all this out. Okay. So in this case, if we go back one low, so I like to go to the most recent swing low. Okay, the most recent, which is here. And then here was the high. And I'm just talking about the last move right at the 23. Now, this doesn't work anymore because we have a new move and I can't use these levels anymore. So now I have to change the low because there's a new swing low in town. And that's here. So from now on, now I have to draw this, and it's a much smaller move, but this up move isn't over yet. I don't know how it could roll over and come back down, and then we'd be looking at the 38, but I'm not able to draw this until it starts to roll over. So right now the swing low does move, but he says if you go back one low, will be the same level. So right here, we always move the levels. So the previous move, so we had this move right here, but the previous swing low was here. So the previous swing low would have been right there. Here's your swing high. Okay, now let's take a look at this. This is great. I said I was going to give a lot of examples, so let's do it. So this one, it bounced down into the zone, 38.2, and then it crossed above. Okay, and so what did we have if we're building a case here? We didn't really have, we had some semblance of trend because it had a big swing move. So this big swing move above the 10 is, it's not a trend, but it's a bull move. It's a swing leg high. It didn't take this out. That's really important level to me. So it didn't take that out. So I would still probably say that this is not a clear uptrend. So in that case, that's not in my favor, but we do have a big bull move. So that is in my favor, but not an overall trend because it's not above here. Now, we are starting to make higher lows though. See that? It's making higher lows. So it could be starting to change. And then we know that later on it does. But so I'm just going to continue to work on this. So we have that. Then we have a bullish engulfing candle here. See how that takes out this high. So that's working in our favor. And we have the cross of the MA. So we've got a bull move. We've got the double bottom, or not a double, a bullish engulfing, bounce off the fib, and a close above. And so we could put our stop. And yes, I did move the fib level. You know, I go from swing high to swing low. Now, in this case, I probably would have taken this trade and it would have been an amazing trade because right here, the entry would have been right there. You can see that's our entry right here. Here's the stop loss. A pretty big stop. That's like a $40 stop, 200, just under 40. But look at the move, right? The move went, I mean, you could technically still be in this, but the swing high here was about 300. That's about a $100 move, right? With a $40 stop, you got a $100 move. That's really good. All right. So, so that, you know, that's a great example. Now let's keep moving here. Let's take a look at another swing high to swing low. So if we go back, we could look at this one. This was a swing low and this was a swing high, right? So let's look at that one. See if I can grab this. We'll move it over. All right, now this one didn't ever bounce, right? You see how this didn't bounce? It just went straight through 38, 61, 78, down to 1, and then finally it bounced at 1.3. And so the question is, would I take this trade since it was never a fib bounce? The answer to that would be probably no, because it was too deep. The retracement was too deep. If the retracement goes too deep, I'm not interested in it, because that's telling me that the trend hasn't been decided yet. Okay, so the retracement was too deep. So if it goes anything more than the 61.8, I'll go and find something else, right? It's too deep of a pullback. And so that would have helped me avoid this trade. And like I said, we're not going to win every trade, but if it's a deep pullback like that, I'm not going to take it. Okay. So let's take a look at this one. This one might have been a losing trade. If we look at, so we go over here, we got a swing low, and then we get the swing high right there. Okay, so this one, we get our trade. It pulls back. Where did it pull back into? 38.2. And we broke above this level. So I'm thinking, okay, we got a nice bull move, an uptrend. We broke above, and then I would have put my stop down here. And so this one would have been a loser. This trade would have lost. And so it would have been a nice tight loss, but it would have been a losing trade. And I would have taken that because we had nice consolidation. We had support. We had a lot of things going. It looked pretty good. And I probably would have taken this trade. So that would have been a loser. But again, we've just looked at it. Sometimes you'll avoid the losers because the retracement was too deep. Sometimes you'll avoid them because it didn't cross above the moving average. You know, if you can build the confirmation, you're going to increase your winning percentage. And, you know, back to the example that I showed you with my spreadsheet right here. The more you increase these numbers, the better you're going to be. Okay. And let me explain something. Okay. Something very simple. If we understand that we're taking $100 losers on average, and we are at a 50% win rate. Well, let's say we really do our due diligence on our trades. You got to take your time and do your due diligence. Don't take every trade. Build a nice strong case and find the ones that give you the most signals. Because if you can increase your winning percentage from 50% to 60, which really is not that much work, but you're going to double your money just because you're taking a better selection of trades. So don't be careless with your trade entries. And if you find that you're able to do more technical analysis, find better research, look at your trades, you're going to see your profits improve. And I'll just tell you also, you know, I talked about managing that risk from 2,100 to 4,500. If you can learn to be consistent with your money management, that's the most important thing. Consistent with your risk management, you're going to grow your account. The people that have a hard time are the ones that just can't handle taking a loss. You might say in your mind, I know it's going to turn around. This is a good company, blah, 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 blah. But the truth is you don't know what's going to happen. You don't know the future. I don't know the future. Nobody knows the future. Anything can happen. Just do your due diligence and manage your risk well. It's the most important thing. And then from there, you want to really just find the best entries, quality entries. And if you can do those two things, you're going to do really well. And just practice and be consistent. You know, the key to being successful is to be consistent. When you go out and you do something new, you know, like I've been practicing my running recently. I'm trying to run a marathon. I think I'm a little crazy. Well, actually, I know I'm a little crazy. I want to run a marathon, but you know, I start out the first day, I ran like half a mile and I thought this isn't going to work. And then, but I kept at it. And every day I got a little bit better, a little bit better, a little bit better. And so you got to do the same thing with trading. Just do a little bit at a time. and slowly improve, you're going to do fine. All right. I think I'm out of time, but I just want to thank David and Anka for giving me this opportunity. Thank you guys. And I want to thank the audience for being so attentive and engaging. Thank you all. Oh, and if you're wanting to get a copy of that spreadsheet, just send me an email and I'll send it to you at caseystubbs@gmail.com. And you can find my podcast. It's How to Trade It. And my website, it's tradingstrategyguides.com. And my podcast is on the website as well. Lots of strategies, lots of education there. Thanks. Thank you, Matt. Thank you, David. Hey, Andrew.